What did I walk in on?
Using clickbait headlines for getting more.
Yeah.
That's how we're going to attract more viewers.
I think every thumbnail should just be like a picture of Brad Pitt shirtless.
Yeah.
And it, has nothing to do with our discussion, but might help.
25th episode of Farm to Markets, and today we were talking about if stocks will go to zero, if concerns over the Fed's triple threat of interest rate hikes, ending of bond purchases, and balance sheet reduction is overrated, and we have another lightning round at the end. The stock market is always dealing with some crisis, from the days of long-term capital management saga to the Greek debt crisis to the mortgage-backed security crisis of 2008 to the more recent issues like the pandemic and inflation. Investors naturally feel a sense of foreboding, which can conjure up disturbing questions like, will the stock market go to zero, which has been a common question we have been receiving lately. Drew, can you unpack this a little bit and maybe provide an answer if you think this will actually happen?
Is the stock market going to zero?
Yes.
This can be taken literally, or it can be seen as more of a reflection of concern from investors. Literally, no. I don't think the stock market is going to zero. I think there are greater odds of Bigfoot winning the Powerball than there are of the entire stock market going to zero. Think about it. For the stock market to actually go all the way to zero, a lot of major events have to happen. First, every publicly traded company out there, they have to file for bankruptcy. They have to go bankrupt. They have to liquidate all their assets. They have to pay off their debts, and they have to close their doors permanently. This is Microsoft, Visa, Walmart, Berkshire Hathaway, all saying, you know what, we had a good run, but we just can't seem to turn a dollar. And for all this to happen, all consumers on the planet have to agree not to spend any money on anything ever again. If money isn't being spent, then companies can't generate any revenue. Presumably this is happening while you're unemployed because you're not making any money either. Simultaneously, every investor on the planet has to agree not to sell any share of stock, or has to agree to sell every share of stock they own and not buy any stock ever again. So obviously, when you break it down, it seems a bit ridiculous to think that the entire stock market can actually go to zero. But I think this is just a way of expressing concern that the stock market might go down. I get it. With a few exceptions, there's been a few short bumps in the market, but overall, the market has done nothing but go up for so long. But the stock market isn't a roulette wheel where eventually it's going to land on black. The price of a stock is just a reflection on how valuable it is to be an owner of that company. As long as companies are making money or have potential to make money, their stocks are going to hold value.
Alex?
Yeah, I'll just echo a lot of that. It is, I guess, theoretically possible, but just sum this up. Basically, I think it's even more likely that if the stock market goes to zero, so the S&P 500, for example, the 500 biggest companies in the country, if all of them are just totally obliterated, gone, never coming back, every single share of theirs is worthless, we've probably been like hit by an asteroid or nuked or something, and you've got way bigger problems. That being said, yes, also like Drew said, stock markets can go down. We saw the stock market in 2008 drop around 50%. The COVID crash was around 40%. The NASDAQ, so during the tech bubble of the late 90s, early 2000s, it came down 70, 80% from its bubble highs. So stocks, obviously they can go down. Literally, will they ever go to zero? Probably not. And again, if they do, you've probably got bigger problems, but stocks can go down if you're not comfortable with the risks of losing 40 to 50% on occasion in, say, the S&P 500. You could always try and mitigate risk some other way. But no, the stock market's not going to zero, not anytime soon, unless there's an asteroid coming that we don't see.
This is the people's concern because they, in their heads, they think that the stock market or their stock investment account is a lot like a savings account. And they see it in terms of dollars. They don't see it in terms of shares of property. But the fact is, every share of property is like a machine that every time you crank the handle, money comes out. And if you crank the handle and $1 comes out, let's say that machine's worth $10, but if you crank the handle and only 60 cents comes out, then that machine's only worth $6. The reason why the stock market's not going to go to zero is because every human on the planet has a price when they all of a sudden they're really interested in buying. So, for example, we got the local McDonald's restaurant here in Whitefish. And if I said, hey, would you be interested in buying this restaurant for $3 million? Most of them would say, absolutely not. I don't want to be in the restaurant business. But if somebody said, I'll give you the entire building and all of the restaurant supply equipment and all of the fixtures in the bathroom for $100. Now, all of a sudden, you're interested in getting into the restaurant business because the deal is just so good, because in your head, you're going, my gosh, I just bought a $3 million franchise for $100. Well, there's a lot of people in line who are willing to pay $120 for that, or $150 or $2,000 or $3,000 or $1 million. And what happens is that eventually people incrementally come back into the market and start bidding the prices back up. The reason why stock markets drop dramatically is because too many Americans, too many institutions, and too many governments are up to their eyeballs in debt. And in order to come up with cash to pay off their obligations, they have to sell hard assets to come up with the cash. And so they sell investments at a time not of their own choosing. The astute investor is the person who doesn't have a lot of debt, who can come in and buy these stocks for pennies on the dollar, and in essence, be able to buy a $3 million franchise for $100 when there's blood in the streets.
I have nothing to add with that, but I would say for new investors and people that are not used to investing, it seems plausible that you can have, if you have everything invested in the S&P 500 fund, that fund that's trading at, how many hundreds of dollars how many, was it like 200 and some dollars per share or something like that, could go from 200 to zero. But I think what they miss is that one fund represents 500 of the largest companies in the American economy. And like Alex said, it would be a disaster for all those companies to be worth zero, because you have to, not only have zero current value. So like Apple would have to, nobody will currently want to have to buy an iPhone, and that company would also have to not have any ability to make any money in the future. And it's possible for one company to do this. I mean, we saw this with Blockbuster. This was definitely the case. Nobody wanted to show up to Blockbuster because they could just order their videos from Netflix, and nobody had any. And once they figured out how easy it was to get your DVD shipped to you, or just log in and view videos online, nobody had any desire to go walk around a video rental store. And so all of a sudden, Blockbuster's future potential earnings just evaporated. So in the instance of Blockbuster, absolutely it happened. It happened with Enron once we figured out there was a bunch of shenanigans going on behind on the inside that basically took that company to zero, mostly because all the earnings they were reporting weren't actually there. So it can definitely happen on individual basis. But when you have a fund of companies, or when you say the stock market, which has 500 companies in the case of the S&P 500, or the total stock market like the Wilshire 5000, the entire American economy would have to grind to a stop. And kind of like Alex said, you would have bigger problems than just your assets, losing all the money in the stock market. It seems easy. It's kind of like asking somebody to count to 10 alphabetically. It sounds easy enough, but when you actually start doing it, there's a lot of you got to do a lot of mental things to actually get to that place. It's the same thing with the stock market going to zero. Once you actually start thinking about it, it's really hard to get every company to zero without there being far greater issues.
That's a good point, Tom. And I think that on the other side of the coin, the other concern is that when Blockbuster is selling for 27 cents a share, it's probably not a good idea to roll in and just load up the boat and buy a bunch of it. In fact, when you're actually putting together your portfolio, you might want to invest in companies that actually have equity in brick and mortar and real estate and supplies and equipment, and not just ideas and electrons.
I like Peter Lynch's approach when picking stocks. He said, if you can't get a piece of paper in a green crayon and articulate how that company makes money in 30 seconds, you shouldn't buy it. So the companies actually need to be good. They actually have to make money. I think a lot of investors are almost looking at the market as a horse race. They're looking at the trends. And this top horse has been winning for so long. It's been winning for so long. Let's jump in. Let's bet on that horse. But eventually that horse is going to have a bad day. It's going to get old. It's going to need to stop racing. But really fundamentally, stocks are just an ownership of a company that you believe is going to make money. And if you think that fundamental value is there, then yeah, stocks are going to still have value.
Yeah, absolutely. And yeah, to summarize, can stocks go to zero? Yes. But can stock markets go to zero? It's highly unlikely.
I hope not.
Yeah, you hope not, because individual, the whole S&P 500, if at least even if some of them went to zero, they'd get delisted far before they ever went to zero too. So as long as you're buying index funds, as long as you follow the rules of investing, that's not going to happen in your account. All right, moving on. A recent CNBC article highlighted the fact that the Federal Reserve is scaring investors with what it calls the triple threat of policy tightening, in which the Fed will hike interest rates and asset purchases and start reducing their nearly $9 trillion balance sheet this year. While investors knew all three of these events would happen at some point, they were somewhat perturbed by the Fed's December meeting minutes, which showed that the Fed members are prepared to start all three of those events now rather than sometime in the future. Do you think investors' concerns about the triple threat are overblown? Drew, what do you think?
I don't know if I'd say they're overblown. Maybe a bit inflated. I think they're certainly validated. Because markets react so quickly to any changes, it tends to give the illusion of panic anytime that news breaks. There's nothing subtle about news in the markets. It's not like when the Fed announces unanticipated policy changes, investors, they sit back and listen, they take it in stride, sleep on it, maybe make a pros and cons list. No. When news comes out, it's Black Friday on Wall Street, and people are rushing to make changes as quickly as they possibly can. Back to the question, are the concerns overblown? I guess it kind of depends on what type of investor you are. Most market news is a way bigger deal to the giant institutional investors than it is the normal everyday investor. If you're a big investment bank or insurance company or a pension fund or a labor union, yeah, these changes can be a big deal to you. But if you're just a regular individual, it's just another day.
Alex?
I do not think that they are overblown. The way I look at it is like this. So in 2007 to 2009, we have a major financial crisis. And ever since, let's look at the US economy as if it was somebody who was in a car crash. They're in a full body cast, they're on painkillers, all, the whole 9 yards. And at some point they have to get out of the cast and do physical therapy and start learning how to walk on their own again. But every single time, so with the US economy, we've tried even the slightest to get the economy out of its casts and off the crutches and out of the wheelchair, whatever. It's had problems. And so the Federal Reserve just comes back in, and the federal government comes in and puts more casts on, more painkillers and everything else. And to me, that means that right now the US economy is very heavily addicted to extremely low interest rates, backstops of all kinds on bad bonds and bad assets and everything else. And so like somebody who's going to have to start doing physical therapy, this is going to probably suck. It's going to hurt. You're going to fall down a lot. It's not going to be fun. You'll get through it eventually, but the harder they try and push this, the worse it's going to be up front. Eventually you are going to have to do this. You can't stay in the wheelchair forever. At least you hope not. But I think it's something that people, investors, especially bigger firms, should probably be concerned about, because we don't really know how many inefficiencies there are in the market right now. And as soon as you stop basically socializing all that risk and taking the bad assets off the board with Federal Reserve asset purchases, when all that stuff stops, all of a sudden we're going to find out just how much bad debt and bad assets there really are. And it could be pretty bad. If they slow roll it, maybe it's not going to be that bad, take it one step at a time. But like I said, the harder they harder they pull the rug out from under the market, so to speak, the worse it'll be. So I do think it's something people should be at least keeping an eye on.
The economy is kind of like a 33-year-old who's still living in the basement of their parents. And in order for it to get healthy in their relationship, the 33-year-old has to move out. And yet the 33-year-old is in a panic because, oh my gosh, I don't know what I'm going to do if my parents kick me out of the house. For so long, to Alex's point, we've gotten so addicted to Fed action, and the Fed, for the most part, has been extremely accommodating with these low interest rates. We all talk about it being a nonpartisan, non-political, part of the government. The fact is, it's incredibly political. I am less concerned. Well, let me back up. I'm going to pontificate a little bit here. First of all, I think the Fed's a really bad idea because the Fed, the way they solve our economic problems is they give the economy fentanyl, to get it jump started in the morning, and then it gives it barbiturates at night so it can sleep. And you do that for long enough, and pretty soon your economy is sick. And that's exactly what has happened. We now have a sick economy because we can't function without the Fed doing something. In order to get healthy, we got to get the Fed to stop doing something and doing nothing. And to Alex's point, that's the pain that we all have to endure if we want to have a healthy economy. The fact is that every time the Fed does something, there are going to be some winners and some losers. If interest rates start coming up, the people who currently own fixed income investments or interest rate sensitive stocks are going to get hammered. However, the people coming into the market, they're going to be able to, for the first time in a generation, to be able to buy safe, secure fixed income investments at reasonable interest rates. So I'm a little bit gun shy about all the wailing and gnashing of teeth and the lamentations from a voting population who is going to demand from their politicians that the government do something to continue living in the basement. But in order for the economy to get healthy, the Fed has to do something, assuming that we're going to continue to have a Fed. So in our business, it's just another reason for us to talk to our clients. But the reality is just follow the rules like we always tell them to follow in the first place. Diversify, buy quality investments, buy things that are appropriate for you, and don't take too much income out of your portfolio on an annual basis. If you follow those rules, your relative position in the economy is not going to change a whole lot.
I'll add 2 points. The first one is everybody, this is not a surprise to anybody. It has not been a surprise for the last 5 years. We've known that at some point this day was going to come. And when the market reacts like it does, it's not because, it might be in part because investors are scared, but I think the article missed the point in that what is actually trying to happen is that large institutions, hedge funds, are trying to squeeze every little bit out of these favorable interest rate environments as they can. They're essentially trying to land the plane just as it runs out of gas. And then as soon as the wheels hit the ground, we're going to retool our portfolio for whatever in kind of environment we have. If we have a rising interest rate environment, we're going to retool our portfolio to accommodate that kind of environment. So, we're trying to squeeze every last bit of earnings out of these favorable interest rates that we can. And then as soon as the Federal Reserve alludes to the fact that we're going to start changing policy, that's when you start seeing them try and get ahead of whatever the policy statement is going to be, and you get a lot of volatility in the market. So that's the first thing. The second thing is that, yes, I think fears about this are a little overblown because I think what the Federal Reserve is trying to do is telescope way in advance that it's ready to start doing these things. When I get my kids ready for bed, I can't just be like, hey, it's 8 o'clock, we're going to bed, because it will go poorly. So like an hour before, we're going to be like, hey, you got an hour, we're going to start getting ready for bed. And then like every 15 minutes, I can remind them, we're going to get ready for bed. We're going to get ready for bed. And that's essentially what the Federal Reserve is trying to do right now, is that we are going to end stimulus sometime in the future. We're ready to do it now. And then when you get like Jerome Powell's comments like he had yesterday, he said, we are ready to do it if necessary, which doesn't mean that we're going to do it now. We just want you to know we're getting ready to do this. And then I guess my last point is that the Fed also is convinced that a lot of, and they may be right on this, but that a lot of the inflation is caused by supply chain issues. And I think that some of it is a result of supply chain issues, but I mean, the majority of it is obviously, I think, caused by the amount of artificial money that's been dumped into the economy. But I think the Federal Reserve also wants to wait and see some of this, pandemic, supply chain, economic issues like work itself out, and then maybe get a better idea of what all that printed money has done to the economy. Because I think they have that they're right. I mean, that the actual inflation rates are clouded by some economic issues. You had the Suez Canal, which clogged things up for a little bit. Then you had COVID, and then you had like a flare up of Omicron, and that causes supply chain issues. The last inventory report I saw, though, is that it looks like companies are starting to build their inventories back up. Semiconductors are making progress on that, and hopefully, in maybe like a year's time, we're going to start seeing some of the supply chain issues resolve itself, and maybe that'll bring down some of the prices and get a clearer picture of what kind of inflation we're actually looking at in the way of Fed printing money.
I like your analogy of giving the children plenty of notice before bedtime, but I want to tweak the analogy a little bit. I think it's more like the dad saying, when I count to 3, I want everybody in bed. And dad goes 1, 2, 2.5, 2 3/4, 2 7/8, and dad's desperately waiting for mom to weaken to the point where she says, just let the kids stay up for another half hour. Because this is kind of what the Fed's been doing for a long, long time. I mean, we've had a peacetime economy for a long time, and we keep having incredibly low interest rates because nobody has the political will to do what is necessary. And that's the damage. My biggest concern about panicking and doing something different than what we're already doing is that mom comes in, mom being the president or the current administration, and doing some sort of fiscal policy to dampen the pain of a monetary policy that the Fed implements that will just prolong staying up and not going to bed. It'll prolong the economy going even longer in an unhealthy fashion because nobody has the will to have upset children or upset voters.
So let me get this straight. We're either incompetent parents, fussy 4-year-olds, or 33-year-olds living in their mother's basement in Houston area. Those are the only options. That's it.
I want to point out that my wife,
people who've been in a car crash.
Yeah, the car crash was a good analogy, and I agree with Alex. It's like once it happens, it is going to be a painful experience, but ultimately it's going to be therapeutic.
Right.
I will point out that my wife did teach me that I had to start telling the kids, early. My solution was just to rip the bandage off and let them. I think pain's good for kids. It helps them grow. All right, let's move on to the lightning round. All right, so the first question comes from research out of Russia, which, according to an article in iTech Post, a recent study claimed that virtual reality goggles made cows happier and able to produce more milk. The idea behind the goggles is to make cows think they're looking at a beautiful open pasture, which will give them an emotional boost, causing them to produce more milk. Joe, are you going to go strap a virtual reality headset to your goats and see if they can produce more milk for you?
Actually, with my goats, they already have a utopian-like life. They have the world's greatest life on my farm right now. The way we run our farm is our animals only have one bad day in their entire life, but the rest of the time, life is pretty much a living utopia. So no, I'm not going to go out and buy $1,200 virtual reality sets for my goats.
Alex, are you going to strap a VR headset to your cat and see if it will reduce its anxiety?
No, they're pretty spoiled. Also, they have lots of windows they can look out and look at the hills out to the west or out in the yard and watch the birds. Last thing we need is them running around crashing into things. They already make a big enough mess as it is with all their toys and then almost toys on top of it. So as far as with the cows, it's kind of weird. It reminds me a little bit of the Matrix. They jack you into virtual reality and hook you up to a machine and start harvesting you. So it's kind of weird, but I guess if the cows are happy, then great.
Drew, what do you think? Is
I
this
agree with
effective?
Alex. It is kind of weird. I mean, we're doing it as humans, hopping into the metaverse. So I guess cows are next. It is kind of weird, but if it yields more milk and the cows have a better life and it doesn't translate into higher milk prices for consumers, I'm for it.
Yeah, I was gonna say this better, greatly increase the amount of milk they produce. Because I mean, if you're buying a virtual reality headset for each cow, that's a lot of overhead.
I think, Dad, your bond to milk and cow analogy has to be tweaked a little bit, whether the cows are going to be wearing VR headsets or not.
All right, winter can make working outside difficult and less enjoyable. Drew, what are you doing to currently work? What are you doing for your workout currently?
I'm just running still, and the winter certainly does make it less enjoyable, but still got to do it.
Alex?
So in the wintertime, hiking becomes snowshoeing, bike riding becomes riding fat bike. And then at Heron Park, we take Alma to the sledding hills, and hauling her back up the sledding hill is pretty good exercise. So that happens once or twice a week too. So that's what I'm up to.
Joe?
I work about 5 to 6 times a week, and in the wintertime, it's primarily jumping rope, push-ups, sit-ups, a lot of calisthenics, step-ups. I've got some dumbbells. And then usually once a week, I'll either cross-country ski or snowshoe Spencer Mountain, which is near my home.
Wow, you're so dominant.
Yeah, in the winters, I usually do like a hit video on YouTube. Those are pretty good. I can do them in my living room. And, I have a stationary bike, and I usually hit that in the winter, so I don't have to go out in the cold. Right now I have a 1-month-old that's pretty fussy, so I spend most of my time just carrying him around. All right, after you get done working out, you're probably pretty hungry, so why don't you tell us what is a meal that you make better than any restaurant? Alex?
So I really like cooking in general. I think I make pretty good pizzas. Steaks I'm doing these days are better than a lot of places, but I'm probably going to go with my hamburgers. So I buy the Wagyu ground beef from Snake River Farms in Idaho. Just do a half-pound burger on the grill, 2 medium, and just a few toppings. And oh man, there's not another burger on earth I'd rather eat.
Drew?
I think fish tacos are something that my wife Kayla and I do really well. It's kind of our thing whenever we go to a new place, try a new restaurant, we always get the fish tacos if they're on the menu, and I've yet to find a restaurant that does it better than us.
Joe?
Like Alex, I enjoy cooking. To be honest with you, I prefer my cooking to most restaurants. You have to be a really, really elite restaurant for me to prefer eating at the restaurant than at home. I like my own barbecue steaks, barbecue roasts, barbecue fowl, like poultry. I also like my own sauteed vegetables. I like stir frying vegetables, and I like the flavor when I cook them.
I can do a pretty mean grilled cheese. I have the palate of a 5-year-old, but I can whip up a pretty decent grilled cheese that I've yet to see be rivaled. My wife makes a wonderful, I don't know, it's basically pasta with cheese and tomato sauce on it, but out of the Instant Pot, but it is fantastic. And I have not found anything better yet. And I will attest that Alex makes some pretty good burgers and pizzas for sure. All right, well, that's it for episode 25 of Farm to Markets. Remember, if you have anything that you'd like us to discuss, leave it in the comments. Otherwise, we'll see you next week.